I got to tell you, it feels really, really good for me to be here. I'm Columbia also. I did my MBA in 1991. And it really is such a pleasure to be here. Last year's Social Enterprise Conference was just phenomenal. And the amount that I learned, it was a privilege. And so it's a privilege, again, to do this. Before we start, a quick introduction. I'm Erika Karp. I'm the founder and CEO of a company called Cornerstone Capital. We're an investment bank and an investment manager, and everything we do is infused with a sense of sustainability. All right? And by the way, when I talk about sustainability, my definition is the systematic integration of environmental, social, and governance factors into everything, the very core of an organization. And we do analytics around that as we make decisions on investing. Okay, so that's Cornerstone Capital. We've been around for about a year and a half, a little less. I used to run global sector research at UBS Investment Bank, and 25 years on Wall Street, managing analysts and strategists and economists, 25 years of having the most brilliant analysts in the world tell me everything about everything. And that is a privilege. And at the same time, what I learned is I believe in the questions more than I believe in the answers. I like to be told the time, but frankly, I really prefer to be told, how did you make the clock? Tell me your methodology. Tell me the process by which you came up and you're trying to earn the right to make an investment decision. So 25 years at big Swiss investment banks, and now it's my turn. So I can talk in a lot of hats. I can talk as a director of research. I can talk as an executive at a giant investment bank. My preference these days is to talk as an entrepreneur, as a founder, as a CEO, in a very complex, highly regulated business. And what I can tell you is that the last year and a half, I have been on a roller coaster. In the course of not even 24 hours, I can go from a soaring sense of wonder to the depths of despair, knowing I'm going to have to sell my house and my kids, right? So, I haven't done that yet. But the reality is entrepreneurship. We won't have to say social entrepreneurship eventually. We'll just say entrepreneurship. Because if an organization, whether it's large or small, doesn't understand the global macroeconomic imperatives to create business models that understand deeply how to move around these massive global imperatives, it's not going to be successful. It's just not. And again, I've spent 25 years looking at business models, looking at analysts, pitching ideas, earning the right to give investment advice. 25 years of saying, okay, is there a business model innovation here that is so special that it's going to be disruptive? Disruptive is good, in my view. Disruptive is also scary. Okay, so if you study economics, and by the way, for those of you who are studying accounting and finance, wonderful. Make sure you're studying economics also. Because economics, you learn how to think. You learn framework. You learn macro. You learn perspective. You learn about governance. All right, and governance, in the ESG governance, is bigger than just, the structure of your board of directors and, your cap table, right? Governance is infrastructure. Winston Churchill said that we shape our buildings, and thereafter they shape us. Think about that. Governance as infrastructure. We shape our buildings. We put in place policies and processes and business models that hopefully facilitate innovation and growth. All right? So when we look at economics, when we look at healthcare and infrastructure and education and climate change, when we look at these massive global economic imperatives, all right, think about what business models can serve these great needs, these existential needs. Think about that. And so I'm going to take a moment to make a little bit of an announcement. Cornerstone Capital Group partners with a lot of organizations around the world. One in particular is the Clinton Global Initiative. So we are the advisor to the market-based approaches track at the CGI. At the CGI this year, just a couple of weeks ago, Cornerstone announced a new initiative that is called Sustainable Games, sustainablegames.com, in fact, if you want to go see it. This initiative is a partnership with Cornerstone Capital, the Clinton Global Initiative, the UN Prime, the Principles for Responsible Management Education, and Rubico Sam, and also NASA. They're going to try to help us create a website. Here's what I just want to say. Being at Columbia, my alma mater, where I learned something about business, I would like to see a Columbia business student win this. I would like to see a Wharton student or a Harvard student, so we're associated with them too. Sustainable Games, the Business Model Challenge, is where we are looking for entrepreneurs from around the world who understand collaboration, globalization, technology, diversity. We're looking for students to partner around this crazy domain bank that Cornerstone has. We're actually GoDaddy's single largest client in the world. We own over 2,000 URLs, domain names. Each of them is a business model, it's a business principle, it's a business mission. Look at our domains. Come up with a model. And then we will help you create it, we will give you advice on it, we will publish it, we will offer $25,000 to support a new business around one of our sustainable domains. So we haven't announced that that's what we're doing, but it's a $25,000 grant, and we're very excited to get the innovative spirit in the student community around the world fired up and empowering social enterprise, which ultimately will just be called enterprise, okay? So, on that note, let me introduce this wonderful panel. Actually, I got a better idea. Let's let them introduce themselves, all right? And again, it's a privilege for someone like me, again, I'm putting my director of research hat on, and to have a panel of experts that have forgotten more than I will ever know about sustainability is a privilege. And so thank you for being here. So I'm thinking, we didn't do this in any particular order, but why don't we start with Nathan. Do you like Nate or Nathan?
Nate.
You like Nate. Okay, so Hewlett-Packard, one of the largest companies in the world. Nate is going to, and then we're going to just go down the road. I would like you to self-introduce, just 2 minutes. Tell us about your day job, and tell us what most fires you up about your day job, and then we'll go on to Mark and Eve, okay?
Yeah, sure.
Over to you, Nate.
Excellent. Can I stand? Is that okay?
You can do whatever you want.
All right. So, Nate Hurst with HP. I'm our Global Director of Environmental Progress. And what we call living progress is the way that HP does business now. What fires me up every day is that I work for a company where 75 years ago, we were a startup in Silicon Valley, really pioneers in Silicon Valley. And our founders instilled an ethic and a value chain that lives strong today. And that is, in the 1940s, they were talking about not only does a business have fiduciary responsibility to grow and produce profit for its shareholders, but also to give back to society and the environment in responsible ways. And you see that in all the business units throughout HP today. And I have the pleasure to get to work with those 275,000 employees worldwide and organize and drive our company with new innovations that are going to help protect this planet for years to come.
Thanks, Nate. Mark. Me.
My name is Mark Sloss. I'm a senior portfolio manager and head of what we call Premier Portfolio Services at UBS. That would be the giant Swiss bank that Erika was referring to. A large part of what my team does is research and opine on what all of the other capital markets participants out there are doing. They can be research houses, they can be investment managers. We supply our guidance and advice to individuals, to families, to philanthropies, to corporate pensions. In some cases, we're just giving advice. In other cases, we're actually taking full fiduciary responsibility for investing their wealth. So it puts us at an interesting kind of center of the web because, and this is kind of what keeps me coming to work every day, we don't just get to know one company, we get to know all companies. And it's what we show up to do every day, is to observe the capital markets, to look at all of the individual participants in the markets, how they interact. There's infinite complexity out there, obviously. When you bring ESG factors into it, it gets even more colorful and complicated and compelling. and frankly, kind of like Danny DeVito said in that movie, it's great to play with other people's money. So there you go.
Yeah, I used to think that. Then I financed my company through the bank of Erika. Just teasing you, Eve.
Hi, my name is Eve Ellis, and I am a partner in the Matterhorn Group at Morgan Stanley, and we are a wealth management team. But a few years ago, we were hearing from clients that they wanted to invest with their values, and my partner and I have always felt that it was important to use private capital to make a difference by the investments in the public markets. So while we have a global sustainability portfolio, we started a different portfolio 2 years ago in the beginning of 2013 that is a gender lens investment. Has anybody heard of that term, gender lens investing? Okay, great. And so it's called the Parity Portfolio, P-A-R-I-T-Y, not to be confused with any other version of that word. And what it's based on, the statistics and the research that shows that public companies with more women on their boards have stronger financials. And the other statistic that was important to us was when we started, only 16.9% of board members of S&P 500 companies were women. And we thought that it was time for a disruption there, getting back to Erika's word as well. And so we invest only in companies that have a minimum of 3 women on their boards, because that was the tipping point in terms of the research, and that meet our rigorous financial analysis and criteria. And so we have 2 simple goals. I say they're simple, but they're not so simple. We want to make money for our investors, and we want to have a social impact on this issue of getting more women on boards in corporate America. And so it just is my passion. We are very much a part of this movement to get more women on boards, and we are moving the needle forward, but it is at times glacially forward. But we do believe that through other activities that we do for the social impact, that we will get there. And to us, parity means 50-50. That's what we were taught in school, so that's where we're going. Thanks.
Thanks. You know, before we leave that, the issue of women on boards, it's a fascinating one. And by the way, the empirical work on diversity, shows that diversity is very, very difficult. That said, it really is very, very profitable. So there's a number of pieces of research. One actually is from your own Columbia professor. I think it's Kathleen Rogers, right? Phillips. She's fantastic work. And it talks about the extent to which diversity is very, very difficult because it creates conflict inside a boardroom. And I know it, and I've seen it. And the interesting thing in particular about the work from Professor Phillips is that it shows that from outside, looking in to highly functioning boards of directors, it looks actually dysfunctional to some degree, but the data shows that it is highly functional. So that, and not only that, but further, the group itself, the board itself, perceives itself as underperforming because of the conflict inside. And that also makes it complexity. When Mark talks about infinite complexity, I mean, I personally, I revel in that. I think it's fascinating because it means for opportunities, it means for arbitrage potential, right? But this point of women on boards, and by the way, the extent of the actual progress on women on boards is not looking all that good. We have not made all that much progress. The OECD is doing a lot of work on this. CalSTRS, CalPERS, a lot of organizations doing a lot of work on it. I think it just hasn't shown up in the numbers. I think all of a sudden, one year, you're going to have a big lift, and it's going to look like, oh my God, we just made progress now. No, we've been working on this for 2 decades. It just hasn't shown up in the numbers. So by the way, when people talk about ESG and sustainable finance, and they refer to metrics as extra financial or non-financial, that's wrong. It is financial, it just hasn't shown up yet. And if you want to be a good investor, don't wait for the empirical proof, because you're going to miss the trade. Is that fair?
Thank you.
Okay. I couldn't leave this. This is too good.
I appreciate that.
All right. Do you agree?
I totally agree.
We're going to see it one day.
Right. No, I think you're right, and I
Okay.
appreciate that. I will say when it was 16.9, it took 3 years to go from 16.3 to 16.9. The numbers for 2014 are at 18.7. So, but I do think it will happen quickly at some point.
Yeah, I mean,
Thanks.
some countries have decided on quotas. How do you feel about that?
I think that in this country we're not allowed to talk about quotas,
No.
although I
This is
think that we have had quotas for a very long time. We just don't want to admit it. They were white male quotas. but I am, so I'm not allowed to talk about quotas. But I do think that that term limits are the answer. There are many, many, many board-ready women. There is a strong pipeline of board-ready women. Yes, women need to lean in, but women are leaning in, but male board members do need to move over. So, term limits.
Interesting, thank you.
Okay.
Okay, Sarah. So Sarah and I, by the way, have been on many email trails together. The NRDC is very well represented at Cornerstone by virtue of one of our senior managing directors being married to the general counsel. It's really nice to finally be working with you.
Nice to meet you too, Erika. So I'm Sarah Gilman. I'm the Chief Financial Officer at the Natural Resources Defense Council, NRDC. NRDC is an environmental advocacy organization that works on climate, on clean water, and clean air. So as CFO, I have a responsibility for a range of things, including governance and fiduciary matters in relations with our Board of Trustees on those topics, as well as running finance and operations in a globally distributed organization, which is quite exciting, actually, and there's plenty to do in terms of thinking about financial systems. So I'm working on investments, I'm working on audits, I'm working on technology systems that support what we do. Every day in a variety of different ways. It's great to be here. I was a member of the Columbia Business School, a class in a decade that won't be mentioned today, but there are a number of my compatriots here in the room. And when we were at Columbia Business School, it's interesting, what was then called the Public and Nonprofit Management Club had 10 people in it. And we met occasionally, we met at lunchtime. And to see the power and the energy in this room and in this whole conference today, the explosion of social responsibility and social enterprise as a concept is really quite inspiring. And what keeps me going and really excites me is seeing people who want to change the world and do that together through the business sector, the social sector, because really it's one world and we're all working toward a common purpose. Throughout my career, I've joined the business lens and the nonprofit from the nonprofit perspective, whether I've been working on the corporate side, if you will, working in management consulting or other industries, or working on the nonprofit side, representing the organizations that are working directly on social change. Thank you.
Again, before we come back to Nate, the idea of NGO, people, NGOs to me are a critical client, as a business person. You're the CFO of a biggie, a really effective one, a really commercial one. How are you treated, for the most part? Are you treated as an asset owner? Or are you as a client, or are you treated as kind of an NGO that's...
Absolutely. So by the investment community, we're very much treated as asset owners. And when you realize over time that we are running portfolios, in fact, and that we are responsible on the NGO side for running that portfolio, it's pretty exciting. I went through a personal transformation myself. For many years, I thought the Board of Trustees was running the portfolio or had the ultimate responsibility for investment management decisions, and that is often the case. But when you are in a role either as a treasurer or a CFO or any other kind of leader within an NGO, you realize that you are bringing to the markets capital. And part of the power of what's been going on in the past year with the divestment movement is seeing that capital come together. So whether I'm bringing $250 million, which in the investment space is not a big ticket number, or whether I'm looking at the college and university, not-for-profit, faith-based organizations together coming to the markets with ideas and innovations, we can make change. And we do have the responsibility of guiding and shepherding those portfolios.
Thank you for that perspective in particular. So in the capital markets, $250 million is not perceived as a huge number. But if every 250 million came together, then we're talking about billions, and more importantly, we're talking about trillions, and it is going to take trillions to address the societal imperatives that we have. But we can do this. And so thank you for that perspective, So let's go to the corporate perspective. So Nate, you started by talking about this heritage. I'm sorry about this, guys. Is it?
They gave you another mic.
Oh, okay. So we started talking about. You started talking about the. Should I just yell? How's that?
Oh, good.
Okay. So you started talking about the heritage. Hewlett-Packard has a magnificent heritage. Now, whether or not that heritage has been displayed in recent years or days through governance and execution and share price, that's always an interesting question. But go back to heritage, but think of it forward-thinking. Now, what would you like to see the legacy of your company be? And then in particular, so give me the vision, but let's talk about executing, all right? Because vision and strategy is all very nice, but if you can't execute, forget about it.
Sure.
So talk about what you'd like to see as the legacy in the, for the next 100 years, and then how you execute.
Yeah, so I think we start from the premise that you don't know what you don't measure. And so one of the first things that we did as a technology leader in, capitalizing on the legacy and where we were in the marketplace is we're the first IT company to measure our global greenhouse gas emissions in all three scopes. So in our own operations, in our supply chain, and in our products. And then we went a step further and we set an aggressive goal in each phase of our footprint. Our latest being the largest piece of our footprint, which makes over 60%, and that's putting our products into the hands of consumers and enterprise customers. And I think that's where we can make the biggest difference, and that's what I get really excited about in terms of the future, that we continue to innovate and think about how can we take our expertise and apply it to our own operations. So we do a thing, every product that we make, we do an HP on HP. So how is this working for us in terms of our own data centers? How do we take our what we call HP Moonshot technology, which is a server that's 89% more energy efficient. It's 70% cheaper and 80% smaller in size. How do we take that and apply it to our own operations? Well, what we did is we were able to eliminate data centers completely by using this technology. And then we have a real story to tell, to governments in the public sector where we help them drive down and reach their goals, to B2B customers, to consumers.
See, this is awesome, because when it comes to ESG analytics, you would think, okay, HP tech company, why is it the greenhouse gas emissions that's the most interesting thing? Why is something more material, like, human capital, intellectual property, IP, why isn't it that we're talking about? So to you, to HP, when you look at a kind of a materiality matrix for investors, what really matters? Is it the GSG, or is it some S, some social, or is it some, is it some G? Is it some governance? How do you talk to the investment community about ESG and materiality? What matters most?
It's a bit of all those, to be honest with you. In sort of the upper right quadrant of materiality, we do a materiality assessment. We actually did our last one in 2013, and we're refreshing that this year. We put out a living progress report every year annually. The next one will be out in June. The issues that come to the top, climate is one of those. That there's no doubt that climate change is impacting businesses and supply chains and disrupting them.
So you believe 99.9% of the scientists? You actually?
I do. Yeah.
That's fair. It's fair.
And if you want to see how our CEO, Meg Whitman, believes, she wrote the foreword for the S&P 500 Carbon Disclosure Project, otherwise known as CDP, climate change report this year. And I'm happy to say, as we keep reaching for the stars, so I have to figure out how we get better. We scored 100 out of 100 and an A for performance and transparency this year. So
it's not high enough. Nobody should get 100 out of 100. Sorry. No, just teasing. I really do think that's awesome. I think it's awesome, and I know Meg wrote that piece. And by the way, the CDP, the Carbon Disclosure Project, this is some foundational data that is used across kind of the investment community and ESG. And so you're leading the way on CDP data and disclosures. Transparency and disclosure is huge. all right? Look at any industry, any sector. Transparency is potentially transformational, all right? Data, good data is potentially transformational. So thank you for the work that you guys do.
Yeah, and just one follow-up on that is that, reporting to groups like CDP is now essential for business in terms of your B2B customers. I formerly was at Walmart. I know you wanted to bring that up, so I'll just go ahead and do it. And Walmart is a big customer of HP. And one of the first things that Walmart does now when they look at who they're going to do business with is, do they report? Are they transparent? What are their greenhouse gas emissions? Do they report into CDP? How do they score? So, just to stay ahead, in the business world and work with our customers, it's absolutely essential to think about these big three.
Let me switch hats once more. I am on the founding board of an organization called the SASBE, the Sustainability Accounting Standards Board. SASBE is about reporting, disclosure of material environmental, social, and governance factors. And so when we talk about these issues, in terms of getting involved, go take a look at SASBE and what we are trying to do. There's something called the Global Reporting Initiative, the GRI, which is the gold standard for disclosure of ESG factors, broadly speaking, in terms of stakeholders. SASBE is a U.S. pragmatic implementation of the GRI kind of dream, right? And so if you want to get involved, go look at SASBE, go look at the materiality of ESG factors, go look at the investment laws, go look at the Supreme Court and their comment on what reasonable investors need to know. So thank you for the work on that. Yeah. So Mark, you got to decide whether or not people should buy shares in HP. And or you got to decide which managers they should invest in, which may or may not do the analytics around sustainability. So talk about the extent to which you can evaluate what asset managers, what strategies are making a difference, while at the same time showing competitive returns.
Well, I guess it's a bit of a definitional exercise to start with. What does it mean to make a difference? Why do clients come to a firm like Morgan Stanley or UBS? They're looking for
or Cornerstone.
Or Cornerstone Capital.
Yep.
They are looking for participation in the capital markets. They're looking to find places to invest their assets and receive a return of their assets and a return on their assets. More and more, we have clients who are thinking differently about what that return might look like. We've moved beyond the traditional view of risk and return, and now thinking about what you call extra financial, but ultimately will prove, I think, to roll back into fully financial.
Pre-financial. It's just pre-financial. It'll be financial, believe me. It'll show up. Is that fair?
I think that's fair.
Thank you.
So what we're finding as we work with money managers who've chosen to specialize in this space is that the marketplace has kind of moved beyond this divestiture notion, which we kind of call old SRI, and I noticed that so far the term SRI has not come up, socially responsible investing. There are a multitude of reasons why it doesn't get used too much anymore. It's too judgmental, it's too old school, it tends to be identified with a very specific group of investors, so let's put the term to the side for the moment. But the basic technique that was being used there was one of exclusion, which is find issues of concern and try to eliminate them from your portfolio. Look at companies on a matrix of issues and kind of gauge how they're doing, and then decide who you're not going to allocate capital to, which is, it's an interesting notion, this idea of depriving companies of capital, and particularly in the public markets, to try to change behavior. I think the reality of it is that that doesn't end up moving the needle all that much. I think it does raise awareness. But in terms of changing the trajectory of a company the size of, candidly, of an HP or a GE or somebody like that, by some investors or even many investors choosing not to invest, that in and of itself is not really sufficient. So what we've seen is this step beyond just simple divestiture behavior, and now starting to look much more affirmatively at how to allocate capital. And rather than trying to avoid what you consider the worst practitioners, well, let's go out and make the allocation of capital at a very fundamental level to who you consider to be the best of breed, industry by industry. Now, there may be some industries which are more predisposed to those kinds of companies that exhibit that sort of behavior, in terms of the E, the S, and the G. But when you think about it, and in Erika's own material, she uses the term regenerative when talking about businesses that operate on ESG principles, that you have this virtuous circle of good behavior in environmental terms and social terms and governance terms actually kind of folds back into a more productive business, frankly. So it's, from a fundamental investor's point of view, if you're looking to allocate capital, rather than obsessing over who you don't want to invest in, go look for the companies whose behavior is consistent with your view of the world of the capital markets of that particular business, and you'll actually find that in terms of corporate performance, that they tend to do better. Certainly the old myth that went along with SRI that you did worse by allocating capital in this way. There's incremental risk, or there's some percentage give up in the return that you're going to get. And that mythology, I think, has been dispelled at this point. There are numerous financial market studies. A number of academics have taken this one on as well. So while I think we're sort of pre-financial in terms of that alpha, that outperformance that would come through portfolios, I think it's definitely demonstrated at this point that it's just good fundamental investment technique at this point to go that way.
This is why we invited Mark here, because this is a pragmatic approach, right? This is a pragmatic way to make progress. And Mark commented the word regenerative. At Cornerstone, we define corporate sustainability, or really, I actually prefer the term corporate excellence. And we define that as the relentless pursuit of material progress towards a more inclusive and regenerative economy. All right, that's our term for corporate sustainability. And ultimately, we won't be talking SRI, and I rarely, if ever, use that term, because any term that has, an opposite that could be kind of obnoxious. So if it's not SRI, then it must be socially irresponsible. I don't like black and white. I think we need to use language in an inclusive way. And that's one of the reasons I don't use that term. So if everyone knows, we have impact investing, SRI, socially responsible investing, double bottom line, triple bottom line, values-based investing, lots of terms. You know what? It's investing, right? So I think that's where we're going to go. Eva, I'm going to skip over for you. Sarah, Mark mentioned divestment. And we're going to come back to Eve. Well, because, this is interesting. When it comes to divestment, a lot of people ask, where are you at Cornerstone on that? Because, we're very out there on these issues. We believe, I'm going to use one of our URLs, actually. We kind of believe in Darwinian divestment.com. Anyway, and .org. But the reason we say that is because we think it is a Darwinian imperative. If we want to exist, we do need to get off fossil fuels. The question is when and how and what is doable, all right, given that the something on the order of $32 trillion has been spent building the current fossil fuel-based infrastructure of the world. So what we need to invest to be able to kind of power the world, which we need power, we need social rest, not unrest, but we need to invest about $1.5 trillion a year in alternative energies to get where we want to be and keep from getting to the trillionth ton, all right, of carbon emissions. There's a reason we bought the trillionthton.org also, right? So I know this is crazy, but language and the articulation of what we have to do is very important. So Sarah, let's talk specifically about your views on divestment and products and strategies that make material progress.
Sure. So divestment, I agree with a lot of what Mark had to say about the need to invest in clean energy and to what you're saying too, looking at the positive aspects of where we would move forward with impact investing. But divestment certainly has a place, I think, in sending messages to the financial services industry, to the capital markets about climate. And it's also about the power of people and how groups of investors can come together and who impacts change. So those of us who were in New York this past month and here for the Climate March, 400,000 bodies marching down Central Park West, down Broadway, across 42nd Street to send a message about climate. part of it was the investment strategy. And I know Cornerstone actually had a group marching. In 2011, I found an article in Rolling Stone magazine, and it was actually brought to me by employees at NRDC who said, you've got to pay attention, look at this movement, it's about divesting from fossil fuels. And I said, I felt like I didn't know anything about this movement. And in fact, I realized that really the movement was just beginning then, just a couple summers ago. And it started on college and university campuses. There are about 450 chapters of college and university students who are sending a message that portfolios need to be divested from fossil fuels. Now, why? There are many different points of view on it. And NRDC fundamentally believes that we need to, again, send a message that this is a most pressing concern that the world faces today. Others believe that we should divest from fossil fuels in order to really protect our investment portfolios, because at some point there will be a carbon asset bubble, and that the value of those assets underground, the reserves in oil, coal, and natural gas, if you add them all up across the entire world, across the balance sheets of those companies, if they were to be burned, they would emit more carbon than the world can handle, right? So there's an overvaluation. You can't burn all of those assets. They exist, but they can't be sent up into the atmosphere. So divestment developed over time, and now there are 150 different faith-based organizations, colleges and universities, pension portfolios that have chosen to divest from fossil fuels, together totaling about $850 billion. So, you know, it is a story that's being told. It's in the Wall Street Journal, it's in the New York Times, it's being debated and discussed at boardrooms, and that debate and discussion is part of the power of this movement, really.
Can I ask a question?
You bet. You guys really.
Are you at all concerned that the divestment movement ends up being something akin to hashtag activism, where it's easy enough to march on the chancellor's office and say, you know, we want the school's endowment divested of big carbon companies, but yet all the lights are left on back in their dormitories. You see all the cars parked on campus. You don't see the change in behavior that goes along with that. And do you think that kind of disingenuity ends up kind of undermining what you're trying to do on the capital market side, because the behavior that should go with it in order to really affect change it's not happening yet?
Well, I certainly believe personally, and we believe as an organization, that there are many different aspects of the energy crisis, right? And there's no one solution. So divestment alone will not, I'm echoing a little bit. Anyway, divestment alone, thank you, will not send a message alone. And yes, we all have to address energy reduction issues on campus or in our lives, you know, and we also have to approach the investment markets through shareholder advocacy and using other tools as well. So it's one tool in a portfolio of many tools that need to be brought together. So the question that we faced at NRDC was, let's see if we can get the technology always. Thanks. Wow, magic. Once we decided to divest, great. The question we faced was, how do we go about doing it, right? We were one portfolio, one small investment portfolio, but we knew others wanted to join us, right? And so we looked at our different strategies, and if we're going to get out of oil, coal, and natural gas, our exposure was through the S&P 500, was through passive index investment products. And we said, wait, we're not going to be the only ones who need to do this. This was about a year ago. And we said, and so it was early in the divestment movement, which will continue to pick up steam. In any event, we said, how are we going to do this? What products are available? And we said, we can go to the marketplace, and we can go to the largest provider of passive funds and bring together an index provider as well. So look at the companies that provide indices and bring those companies together and say, okay, we're going to structure a passive index product to divest from oil, coal, and natural gas. And we approached the markets. We went to the largest providers. We found a partner in BlackRock who was willing to launch a product with us to take the risk of proving demand. And we are proving demand because the product is taking off with interest. So just 4 weeks ago, we were approached, NRDC was approached by the Swedish Parliament, right? So saying, okay, they have a large sovereign wealth fund, they have a very large investment in their pension. As a country, they're great question, because of course they depend upon the oil industry for their economy, but they want to send a message. They see a responsibility toward climate as well. And they too are questioning what they should be invested in as a country, right? So you're seeing some of these large sovereign wealth funds also addressing the question of whether to be invested in oil, coal, and natural gas. It's not going away.
I got to give a shout out to Sweden, okay? So if you haven't been to Stockholm, it is one of the most sustainable cities in the world. And I can actually speak a little Swedish. Sluta snacka. And what that means is, I'm not joking, it means stop talking and start doing. All right, so this is how you move the mainstream of the capital markets. BlackRock, by the way, they apologize. Our friend Chad Spittler, who looks after sustainability in the U.S. at BlackRock, is based in San Fran. He couldn't be here, but this is where you have to move the trillions. Working with Morgan Stanley and UBS and BlackRock and Cornerstone, this is how we get it done. Speaking of getting it done. And Nate, I know you have something to add. I wanted to talk about products, bringing products to market that move. So can I come back to you for a second?
Yeah,
I wanted Eve to get in here. Challenges of bringing products and strategies to market to move.
Well, first of all, I want to actually commend NRDC, because I think bringing that product to market is huge, and it shows how you're recognizing how to increase your power and increase your reach by partnering, cautious and wisely partnering, and I think that's one way to bring products to market. For us at Morgan Stanley, I think we are a bit of an outlier, and it was easy because we did it. We decided to do it, and we did it, and we implemented it as ourselves, as our wealth management team, and then were later recognized by Morgan Stanley for doing it. So it's not, I don't know if that's a great answer. It's just, it's not something that everyone's doing. Although I have to say, as soon as I read the research, I thought, of course everybody would look at the composition of a board and decide whether or not to invest in that company. So it took us a while, meaning we spent 6 months. Sometimes that's a short amount of time, sometimes a long amount of time. But it took us 6 months to figure out what the product would look like. And then we found a few investors and went live with it. So, and it is time consuming to continue to work on the product. But as I said, it's in my bones. It's what I care about. It's what I think about continually.
See, we got to give Eve a shout out. A lot of times in progress, in economics, in history, in philosophy, everywhere, people use the phrase standing on the shoulders of giants. Well, let me tell you something. Giants are standing on the shoulders of people like Eve, all right? Small groups of incredibly dedicated, brilliant, pragmatic people get it done. And the giants, come along. So, thank you for the example.
Thanks, I appreciate it.
So Nate, what will you talk about the products, and you were going to talk, I think you were going to talk about the fossil fuel divestment
I was just going to ask,
stranded assets?
I just wanted to ask a couple questions. One is, have you seen an increase in shareholder resolutions asking for divestment? That's one question. The other is, I sit on these earnings calls, I listen to our CEO and our executives quarterly report our earnings and listen to the questions that investors ask, and they never bring up these issues that this panel is about. And I think that if that happened more often, I think you would see, change come quicker. So I'd like for you to address that, or anyone on the panel.
This is one of my favorites.
Right.
Okay. So investors actually are asking these questions. Again, so I managed a team of about 600 publishing analysts globally, okay? Analysts, most of them on the sell side, don't know the language of sustainability, and neither do the CEOs, okay? So what you need to do is really deeply understand what sustainability is about, all right? We can do an entire pitch to go long Rio Tinto and short Glencore and talk about every SASBE metric of material importance, okay, whether it's stakeholder relations or energy efficiency, or the cost to build a $4 billion mine, which gets shut down because they lose their license to operate because they pissed off the local community, right? Did I use the word sustainability in that little rant? I don't think I did. We can talk about water efficiency for Diageo or Coke or Pepsi, and we can ask, you operate in the global emerging markets where there's massive water scarcity, and you're not going to have any water to sell your stuff. Are we worried about that? Did I use the word sustainability, right? So investors care about material issues on revenues, on costs, and on risk mitigation, but they don't use the language of sustainability, and the CEOs don't either. So the CEOs now happily, and the boards of directors, are being trained now by the United Nations Global Compact, by the Clinton Global Initiative, by hopefully the governance in business and the world to learn the language. Because once you know the language of sustainability deeply, you don't need that damn word. All right?
Sure.
So the questions are being asked. They're not being asked systematically enough, and they're being asked in a different language. Is that fair?
Yeah.
I know yeah, but go ahead.
I just want them. It's sort of like investing in a product that you think, okay, I'm willing to pay a little bit more. Like a really simple example is when we set this big goal to sell CFL light bulbs at Walmart, right? We made the product cheaper, and so people bought them. And if investors led with messaging around, you could say all these things like in our case there was an earthquake in Japan, and it disrupted your supply chain, and ink supply was disrupted. What's that mean to your customers? And we're worried about that, and the effects of climate change or coastal flooding. Like if they ask those types of questions early on, I sit on these calls, and even if you're not using these terms, I'm not hearing the issues come up. So, well, as much as I would like,
you bring up an issue of the long term versus the short term.
Yeah. Right.
So if you don't ask a question like, what does HP think about the risk of coastal flooding? Or what is the risk to the resilience of your supply chain if we're seeing, coastal flooding? It's a different way to ask the question. And so investors that are looking at incremental revenues, reduced costs, improved risk profile, and resiliency in the supply chain, well, the CEOs do answer and care about that. But again, I think it's a definitional thing and the language thing. It's really, this is not an easy question. It goes to the long-termism versus short-termism. Mm-hmm. All right, also.
Sure.
Because face it, there are just kind of moments in time when the short term and the long term kind of collide in the stock market, right? Short term, high frequency traders are not asking these questions, no. But long term investors are asking these questions. You asked, I want to go back, you asked about resolutions. Conveniently, our head of research is also one of the world's leading experts in corporate governance and engagement. John Wilson worked for TIAA-CREF. He voted about $500 billion in proxies, so he knows a little something about that. The empirical data will show you that, yes, the number of resolutions made, and surprisingly, by some very large asset managers that don't talk all that publicly about what they're doing, but the number of resolutions made in toto, and this is public data, that revolve around ESG factors has gone up dramatically. There's a material increase in that. And then some of these asset managers that you might not think of as sustainability-oriented asset managers are actually doing a lot around resolutions. They're doing it quietly. Corporate engagement is a science and an art, and in very cases, with the big money, sometimes it's done quietly. So that's another topic, and we'll have John Wilson here next time to talk about it. But is that helpful?
Yeah,
some
thank
of
you.
that stuff? Okay, cool.
Thank you.
We were going to go to Eve, and I was not done with that product introduction thing and the divestment thing. So can you talk about a little bit more about fighting, jumping hurdles, generally? Could you give, and if you guys, feel free to make it personal. It's just us, right? It's a Chatham House rules a little bit here. So let's make it personal. Could you talk about, each of you, some of the personal hurdles that you have had to jump to do the really special work that you're doing? So Eve, you start with that one.
So, I don't know if it was such a hurdle because it just seems so logical. I think initially when I was reading the research, as I said, the research that set me was really about catalysts specifically that said returns for companies that had 3 or more women on their boards had a 46% higher return on equity, a 60% higher return on invested capital, and an 84% higher return on sales. And so when I was reading this, I was thinking, this is really not a gray area. These are substantial numbers and a real substantial spread. So the question is, was it really a hurdle? I mean, I guess it was a hurdle to start the parity portfolio, but I think part of it did come from the vision, as you were mentioning before. And I think there's one hurdle that we face right now, which is male investors seem to get it and understand it in a way and act on it in a way that women have been slow to act, whether women philanthropists, executive women, they're coming in to invest, but I think that it's a hurdle to get them to treat their own capital as capital, where they're making decisions about what they want to be doing with their own money. And so it's been a bit of a challenge or hurdle to say to women, you need to act or you're going to be late to the table. And I certainly did not start this investment product for only men. So that's been a bit of a challenge to get women to recognize that they have the power that they have and to speak with it and that money talks. Other hurdles, you know, I'm in a hurdle now and just saying, look, Morgan Stanley needs to have more women on its board. It's not a secret. There are 2 women. And that's not enough, and we need to work on it. It doesn't necessarily need to come from me. But I think, you know, the challenge has been to sustain what we're already doing, but I think we are. I mean, in other words, we're looking to make money for investors, as I said. We're doing that. We're meeting, last year we've had very strong returns. We're only supposed to quietly say what they are. That's a hurdle that we need to get through, having the longevity so that we are allowed to state our returns publicly. If you want to know quietly, I can tell you afterwards quietly, but we're looking for target average returns of 7 to 8% net of fees. Yes, we were way over that last year, et cetera. So I think that's a bit of a hurdle, and also I think having investors understand about risk, because I think investors don't focus so much on risks, and that we do this in a very risk-focused way in terms of creating the portfolio and getting investors to understand that message, that this is not an index. We're not just saying, okay, our investable universe, that's the portfolio, that's that. To get them to understand, no, my partner's a CFA and a CPA by training. We're looking at free cash flow. We're looking at consistent profitability. We're looking at valuation, as well as other factors, which I might say that during the qualitative analysis, after our fundamental analysis, during the qualitative analysis is when fossil fuel companies would drop out of the picture. As a result, actually, we are only missing one sector in the portfolio because we want it to be well diversified, and it is, and we are missing the energy sector for obvious reasons. We would love to invest in a clean energy company, and that will be down the road for us. So the challenges are just sort of basic portfolio management challenges, and obviously running our wealth management practice at the same time. But I have to say, I do feel as though I am really walking on the shoulders of all these women who were in the financial services before I entered the industry and who really spoke out seriously about getting a fair deal in this industry. And really, if they hadn't done that, I wouldn't have been able to enter.
Thank you. Sarah, you want to take that one, her?
Yeah, sure. And there's sort of 2 dimensions to my answer. And so the first challenge was really in my own thinking, sort of the growth in my own thinking about how to approach the investment market. So coming out of the operational side, I really first thought about return, right? That's the obvious, first question is how much money are we going to make in a product? And cost partnered very quickly for me personally as I looked at different products and I looked at different, options to access the marketplace. And that was always, as a training as a management consultant and as a, practical matter, cost is really pretty easy to understand. that you have to look at return, you have to look at cost. But then as I start to add 2 other dimensions always to investment analysis, and I'm looking at risk, whether it's volatility, whether it's liquidity, whether it's other kinds of market risks, sort of looking at risk across multiple dimensions itself is a challenge. And then when you really realize that you look at those 3 legs of the stool, return, risk, and cost when you're considering investments, but it has to be underlined and strengthened always by the social sector, by environmental, social, and governance issues. So how do you then suffuse that through everything you do? And keeping those 4 different factures running at the same time in your mind, and not just thinking about return, and not just thinking about cost, and you really rising the question of climate, into the investment decision at the same time as considering risk, and which is sort of perhaps more fundamental for those of us also with accounting and governance training. So on a personal level, then, for me over the last year, it became pretty obvious when I looked at different factors that if nonprofits, colleges, and universities, foundations, philanthropists went to the markets together, we would be able to access the investment markets in a much more cost-effective way, right? It became obvious when I looked at different products, 6 basis points or 100 basis points. That's a really big difference, and it's going to turn, or 2 and 20. Whatever the model is, you're talking about very different fee structures. And if we go together to the markets, how do investors go together to the markets on social governance issues? That's really the question, because when you look at a portfolio, NRDC has a set of issues, right? Save the Children will have a different set of issues, around child rights or child pornography. Those are really obvious things that an organization like Save the Children, for example, would not want to invest in, right? Or Darfur, Columbia University does not invest. That's their screen is Darfur, right? And what was happening in South Sudan. So other organizations are clearly divesting from tobacco, from firearms. There are many different channels. If we each organization has to find its platform and the things that it does think it does not want to invest in, and likewise the products that it does want to invest in. But the question is then, how do we approach the markets together? And is there a common platform? Because we will drive change much faster if we do it together.
See, this is so interesting, because when we talk about hurdles, the extent to which you can make sweeping generalizations and find commonalities, these are hurdles. And so that's a very articulate description of the nature of the hurdles. It is, as Mark says, infinitely complex. But Nate, hurdles, especially, again, working for a company like Walmart and HP, companies that have been under, substantial fire. Talk one again, personal hurdles, and also just a quick summary. And I'm going to ask you to answer this next question with one word. Okay. I remember I used to run the morning call with all the analysts, right? So the first question, hurdles. The second, how do you kind of suss out true corporate excellence, corporate sustainability from greenwashing? My challenge to you is to answer that in one word. But first, I'll let you think while you answer the hurdle question.
Nice. So I think we touched on the personal hurdle before, is that when you work in these big companies, you live in this, you're judged at the very top quarter to quarter. And some of the investments that we make in the environmental space and in our products they're long-term investments. The return on the environmental attributes is more long-term. And so, balancing that is difficult. One of the things that I've had my team work on is we're trying to measure and evaluate the impact that environmental attributes of products have on incremental sales. And so looking at some of our big global accounts, we're looking in the enterprise space first, just to get a sense. And there's some great customers that are good facilitators of our products, and we've seen some impact, some big impact. But it takes like the right alignment and a certain criteria for it all to come together. And it's difficult, because I wanted there to be this, sort of magic bean that I could then scale and go out to our sales force and say, here's what you can go with. So I think that's a challenge, because as you get that and have those wins, then it's more investment in R&D, right? And then to the point earlier that we were trying to address, then it comes up on these calls more and more and more. So.
Okay, now the hard part. And by the way, you've all had time to think. All right, so this is harder for Nate because he had to talk while he was thinking. One word to tell me how to separate greenwashing corporate BS from true corporate excellence. What word would you use?
Reinvent.
Okay, that's cool. Mark?
One word?
One word.
Greed.
Okay. We'll talk. Okay. Eve? One word.
Intelligence.
Ooh, okay. Okay, Sarah?
Do.
Good,
Okay.
active.
The reason I took issue with Mark's word is because the connotation of green these days is tree-hugging lefty commie.
Oh, sorry, I didn't say green. I said greed
You said greed.
with a D.
Oh, now that's a whole different. Oh, that's interesting.
You said green
Yeah,
too.
he still is. I'm still his biggest fan. That's because Mark can help me write crazy articles like jazz-inspired finance, right? He's a great jazz musician, by the way. Greed, that's interesting. So a lack thereof, to some degree, in the corporate world, maybe kind of defines a little bit about corporate excellence, or
Or maybe
greed?
the opposite. I think that if there's
Even more
truth in the regenerative effects of good ESG operations, you would think that the leadership of the company would appeal to the intrinsic greed that's required in order to have a productive company. So you want to grow, you want to make more money, you want to be more profitable.
Okay, so Mark, we're gonna quote from the
That is more than one
Talmud
word.
now for a moment, and then we're gonna go to Eve. Okay,
No,
so
I was just going like this, that was more than one word. That's all. I wasn't.
True, but this is too good. So I'll break my own rules. Okay, so greed, really interesting. Hillel, as long as we're in New York. Okay, so Hillel's voice. Hillel said that.
.com.
If Hillel'sVoice.com, I don't own it. I actually sold it. It was the first domain sale, the first domain arbitrage. I got 60% net margin on it. Hillel'sVoice.com is owned by Congregation Beit Simchat Torah, the largest gay and lesbian synagogue in the world. Hillel said that if I am not for me, then who will be? But if I am only for me, then what am I? And if not now, then when? All right, that hopefully is a reasonable summarization of capitalism done right. Hillel'sVoice.com. Anyway, I didn't know this would be quite as crazy as it was, but I think this group is just the right amount of crazy to get things done. And so why don't we, I have no idea what time it is because this is really fun. And should we open it up for Q&A? How much time do we have? Somebody? So we have to wrap. Do we have time for a question or two? What do you guys want to talk about?
Thanks so much. This is a great panel. Mark, specific question for you. Curious what UBS's thoughts are on fossil fuel divestment specifically. UBS historically is one of the largest investors in methanol removal in Appalachia, but has recently backed off. And I'm curious if the fossil fuel divestment conversation has played into that decision.
Excellent question. That's been in the media. I'm not part of that part of the business, so I'm not really in a position to speak to that specifically. But more broadly on this question of carbon divestment, this is something that we've been wrestling with on the wealth management side of the house for some time, and not for any reason other than clients are asking the question. Our investors are reaching out and saying, what do you think? What are you doing? What's available to me as an investor, as an allocator of capital to address this? And it's coming into 2007, it was a very, very difficult conversation to have because does everybody remember what was going on in the market in 2007 prior to the crash? More or less. So two things were going straight up in the market. Financial services companies and energy companies. And oil topped out at about $140 a barrel before tipping over the edge. So if you were an environmentally sensitive investor and you weren't invested in these big carbon companies, you were lagging the market. And kind of going back to the prior topic that we were talking about, and the reason that I bring up a word like greed is because, frankly, that's the catalyst for how the capital markets work. It's that fundamental impulse to want to gather, to create, to collect. So that was a difficult conversation to have with investors, whether or not it was done for social or environmental reasons. Then 2008 comes to pass, followed, of course, by the Macondo explosion as well. But people started to appreciate the intrinsic risk from a purely selfish point of view. If you don't care about oil-soaked birds and you don't care about the businesses that were wrecked along the Gulf, you can look at the risks as an investor of being exposed to something like big carbon. And the company who was at the center of that, look at their price chart, even relative to other oil and oil services companies, and you can see the effect there. So we're trying to address it more from a fundamental risk point of view for our investors. On the divestment side, if our clients are coming to us and they are saying that we have an issue concern, and we think that this idea of stepping back from allocating capital into the big carbon companies is a productive thing, or it brings the portfolio into alignment with the mission. In case of NRDC, it would seem pretty preposterous for them to have big holdings in big oil companies, given that the soul, the core, the soul of what that organization's about. So, being responsive to clients like that, by way mostly of money managers who have taken the time and done the research to be able to take a portfolio that is intended to be fully participant in the capital markets and essentially re-engineer that portfolio, excluding certain types of companies. So take out oil companies, take out coal companies, take out natural gas companies, take out MLPs, if it's appropriate, and then use quantitative portfolio tools, fundamental tools as well, to reconstruct that portfolio in a way that you're still getting that complete exposure to the global economy, but you're doing it in a way which sort of insulates or isolates you from that particular exposure.
I'm going to give you a little more direct answer. I still am a shareholder of UBS. Up until a year ago, I sat on the Environmental and Human Rights Committee of the Group Executive Board at UBS. And I will tell you that when you look at that organization and the candor with which the conversations about these issues are occurring at the highest levels, at the board of director levels, and then when it comes to having the debates and then a giant organization implementing a strategy that reflects its values, this doesn't happen overnight, all right? So as a UBS shareholder and as a very loyal former executive of 15 years there, the work is being done at the highest levels to figure out how you balance the pragmatism of being an investment bank and a wealth management company and an asset management company, and do it in such a way that you get the process right for the long run, all right? So the work is being done. It doesn't happen overnight, all right? So we can talk some more offline about that.
Just to add on UBS, is they're a big customer of ours, and they make purchasing decisions based on environment. So, they're a great. Our sales guys talk about UBS all the time and the investments they've made in our most environmentally conscious technology.
Now I'm getting a little verklempt. What did I do? But yes.
So
that's exactly right.
It's just seeing the big picture. I mean, we can all. There's, having worked for two big companies, like, quarterly calls. Headlines in media often drive conversation around you, and there's more to it, as you were, I think, saying.
It's really complex. I heard that Tim Cook is gay. Is that true? This is complex stuff when we're talking about giant ships of state, even. Okay, so I hope that helps. I'm seeing some more questions. Yeah.
Yeah, when you talk about carbon, my background is oil and gas analyst and attorney. Do you distinguish between types of energy, like gas specifically, and like areas where people are operating? I mean, I how do you, it seems like when we're talking, you're painting the whole energy industry kind of in the same brush. Do you make distinctions between different sectors of the energy industry? How does that happen?
Totally, you have to. So if you wanted a slot on my morning call, and let's say you covered Apache, what do you know that nobody else knows about Apache? By the way, isn't it interesting that Apache is incredibly transparent and holds itself to the highest standards when it comes to disclosure on the chemicals and the crap they put in the water to pump down the well? But there's another, type of company versus Apache that doesn't do any of that. In fact, they don't even know how to talk about it. So let's go long Apache and short XYZ, right? So yes, you get specific by sector, by company on what they are doing and how they are doing it. And yes, you get specific on where they're doing it and what matters most in the regions that they're doing it, right? So the answer is absolutely yes. And I love oil and gas analysts, and I love to have these questions with them. And so, this is exactly the point. We were just talking fundamentals. Did I use the word sustainability? No. We talk about the fundamentals. And that's how you decide what stocks to buy and sell. And some people are not going to own anything in the sector or the subsector. Some people, and this is where you can't make generalizations, some people are going to say, okay, just keep me away from the tar sands, but everything else is okay. Right? Pretty much we have seen divestment from coal. Look at coal prices, right? This is different from coal. Do you think natural gas is a bridge fuel? Maybe so. Do you know of a new technology out of Melbourne, Australia called Gain Energy that sells a non-petroleum-based diesel marine fuel substitute, but still needs natural gas as a feedstock? Is that okay? Is that sustainable? I don't know. To someone it is, to someone it's not. This is where it's hard to make the generalizations. Is that helpful? Yeah, cool.
We've been talking a lot about energy certification. I was wondering, maybe is that because that is an area where you can bring the long term into the short term by talking about disasters, and then disasters happen, so like Deepwater, and maybe even Hurricane Sandy had an effect in thinking of New York. Is that what we need to happen for maybe some other areas to come up? So for instance, talk about women on board, there were some big disasters, so maybe it's not moving so fast. Access to healthcare, those kind of issues, that was going to need to happen for more progress and focus on those areas, do you think?
So here's the problem that I've observed from a portfolio manager's point of view. When you're looking at the research, let me back up for a second. The public markets are chaotic, but there's still a fairly efficient pricing mechanism. And is everybody here taking enough business classes to know what arbitrage is? Okay. So pretty much the entire exercise in the market is about finding those arbitrages and exploiting them, and whether it's over a short, milliseconds if you're a high-frequency trader, or over long periods of time. And because that mechanism is very efficient in the market, when portfolio managers, when academics, whoever it might be, manage to tease out a relationship between a factor and a return or an arbitrage in the market, and it becomes known, the entire market piles on top of it. So hedge funds are usually very, very guarded about what they do, because they think they've identified that little arbitrage that if everybody else came in on top of it, would go away. It sort of evaporates when everybody gets to it at the same time. So when we're looking at ESG research and we're looking at the correlations between those factors and company performance, one of the problems that we have is, regardless, it could be the energy issues we talked about, it could be representation of women on boards, it could be how they handle human capital, it could be Aboriginal relations, you name it. Companies that are high performers on those metrics oftentimes do appear to be high performers in the markets, but it's not clear what the order of precedence is there. And that's the difficulty you have as a portfolio manager, because timing is everything. Is it that companies that chose to move towards gender equity in the C-suite and on the boards then subsequently outperformed, or is it the companies that outperform have the luxury of being able to address issues like that, or workplace safety, or organics, or whatever it might be? And how do you invest and how do you allocate capital around that? So when you're talking about these issues and you're talking about it from a pragmatic, I'm looking for a return point of view, that's what hasn't really come out in evidence yet. And I think that market behavior will radically change if that's finally discovered and unpacked in a way that you can exploit it in indexes or in fundamental portfolio strategies. That's kind of the great challenge that I think is sitting in front of us right now.
I don't think that you need some kind of crisis to make it happen. And I actually don't think it needs to be a causal relationship. This is a strong correlation that we're talking about that exists. But I do think it does take, to be a movement, which it currently is, it takes many different players. So, for example, we're part of an organization called the 30% Coalition. That includes CalPERS and CalSTRS and other large institutional investors and 8 state treasurers who care about this issue and who are working on this issue with companies one by one. So for our own strategy, we have a 2-pronged strategy. One is to deal with companies one by one. Some of them will get phone calls from us saying, you're in the parity portfolio, congratulations, it's really difficult. There are only 20 to 30 names in the portfolio, and you've been selected. They want to use that to help them. I mean, one company that's in the portfolio even has a program, is launching a program in January it's a biotech company. They are training, they're going to train women employees for boards of companies outside. They recognize it will be good for them that they will have employees sit on other boards. The other piece of that for our social impact is we intend to call companies that have 2 women on their boards to say, we'd love the opportunity to look at your financials, but we can't do that yet. What are your plans? And then there are other organizations. One is 2020 Women on Boards, and one is the 30% Club, which just came over from the UK, which we're active in. So this is part of a movement. I think the whole movement will get traction as time goes on. I don't think there needs to be a crisis. But the other thing is, the reason I don't think there needs to be a causal relationship, but just a strong correlation, which has been proven by researchers at Columbia and Harvard and Catalyst and Stanford and, I mean, McKinsey, Credit Suisse, et cetera. The research is there, but the financial metrics, there's not a causal relationship there either. To say that a company has X revenues or earnings per share, that doesn't cause that stock price to go up. So I don't really think we need to have that same kind of relationship here either. It's just a strong correlation. It's another indicator of where a company is and how to look at it.
Do we have time? Cool. Right here?
So, I don't know the details of, Sarah, what you were saying about institutions banding together, but I would love to hear a little bit more about that and hear what other panelists have to say, because clearly if you're influential at a big company, your company can make a difference, but there are probably dozens of highly influential companies who are operating in somewhat siloed ways, each trying to make their own mark. And I don't really see cooperatives, or whatever you want to call it, in the world.
There's not dozens. There are thousands of companies. Yeah. And by the way, there are quiet cooperatives inside of industries, across industries. Some are cross-disciplinary. But there is so much grassroots work being done. And yes, you have to try to centralize best practice and then really get scale. But be optimistic in terms of what actually is being done in your vision. But Sarah?
Yeah, I mean, I'll start it. But, you know, when an issue takes hold and parties, different people, different companies come together, different parts of the world, parts of sectors, then you see activity, and it could be almost along any issue. I mean, climate is clearly a question where the press is coming together, scientists are coming together, companies are coming together around risk, and you see a movement forming. So you can get into that movement through many different ways. I mean, Global Ready Women on Boards is another movement that before meeting Eve, I knew of the movement. I knew it was happening because I read on the topic. I started seeing it. So whatever the issue is, it's about building partnerships across parts of the economy, right? So, you know, you look at a corporation. So, for example, they have a marketing department. They have an investor relations department. They have, you know, a sustainability officer, right? And how do you pull those different functions together, I think, around any given topic? And clearly climate, I believe, is going to change the world. There are other topics as well that people feel is a driving force in their lives, and whether that person is working in the government, for example, you pull those people together around around topics, and you start to then achieve change.
There's also something else a little more fundamental that I think has to change, and that's at the regulatory level. The Securities and Exchange Commission, what's missing there right now is that shareholders do not have the full franchise. They do not have a voice that's proportionate to their ownership of these companies. They can provide essentially guidance. They can provide an opinion on the part of the people that actually own these companies, but it's not the fight. If you get the majority vote, that doesn't necessarily change the board. One of the reasons that we don't have adequate gender representation on boards, it doesn't change behavior in the C-suite. It might kind of give them a slight attitudinal adjustment, but I think until shareholders are fully empowered, these confederations, these associations, these aggregations of shareholder interest are going to only be able to get so far.
Let me give you a tiny little micro crisis that, in my view, is a huge milestone for sustainability. Okay, talking about the SEC. So the other day we saw the fact that the SEC, in releasing documents, there's a millisecond difference in who gets those documents when. Okay, I don't know if anyone saw it. I think it was the right column of the FT, right? That is a micro crisis for the SEC that is going to make them wake up to the issues of transparency. This is a hugely sustainable issue. And so we're friendly with everyone knows who Brad Katsuyama is from Flash Boys, right? The IEX, this is the new iteration, the next generation of an exchange that's built on transparency and trust. The reason that I refer to this little article that you gotta watch, this is such a sustainability issue, and it is a crisis. The idea that the SEC built to give confidence to the financial markets. Mary Jo White's a busy woman right now looking at this issue of transparency. So when it comes to the SEC and the issues of disclosures, this little micro crisis, I think, is actually a really interesting tipping point on issues of transparency and reporting of environmental, social, and governance factors that are material. So that was, by the way, I speak much more quickly when I am in New York than I do in, any place else. So that's a complicated little story that I just told, but we could write articles about this. Is a big deal, I think, for the field of sustainable finance, which again ultimately will just be called finance. Any other? We have one more. I see. Yeah. Rajesh, could you just repeat that question? I don't know if they all heard it. How do you deal with
the confusion called green? Confusion of green. You talked about
the confusion of green?
Just taking it a step further, because most of the time we are inundated with calls, and in India we have 5,000-year-old cultures. People are well aware of philanthropy and charity. So most of the time we are teaching organizations that you need to imbibe in your core strategic vision the concept of financial returns along with social returns. Because most of the time organizations are driven by the greed, as you rightly mentioned. So the investors keep talking to us, and we get confused because if you recently look, the logo of BP has become green, McDonald's has become green. So all this confusion prevails. Can you throw some insight into so that we can, inform people a little better? Thank you, Erika.
Nate, you want to take that one? If anyone doesn't know, I wasn't able to see. That is Rajesh Tiwari, my bhaiya, my brother. Rajesh is the founder of the ICCSR, the India Center for Corporate Social Responsibility. And a shout out for India, the extent to which companies that want to do business in that great nation need, actually by law, now to spend 2% of their revenues on corporate governance and training on corporate governance. So I am a very proud partner of the ICCSR at Cornerstone. Thank you for the question. And I'll give the hard part to Nate here.
So can you help me I just want to make sure that I answer there was a lot of components there.
So, yeah. So just to summarize the question, I mean, how do you sort through, the corporate BS? And that's really the question, right?
Yeah.
I mean, yeah.
I think Look, transparency. I mean, I might have said that word when you asked the one word. There is a lot out there where, you know, it's marketing and green marketing, et cetera. And what I would challenge you as individual investors or as purchasers, like, vote with your pocketbooks. Go and look and see how transparent the company is, and read the reports that they're doing and ask all these questions and find ways to ask them. I mean, all of you are probably on social media. Like, companies monitor these things. And I think it all comes back to your own personal mission. Like, I was thinking about all this conversation, and in my own life, like, one of the best assignments I ever had in business school was writing my own mission statement, which you don't have to use words like sustainability and other buzzwords, but what is your purpose in life? And stay true to that, no matter what decision you're making, whether it's investing, the company or organization you're going to go work for, et cetera. And I think that's how you can start to move the needle and bypass some of this.
See, Nate gives me the perfect opportunity to close us out, to thank everyone, because mission statement and legacy, you know, the mission of my firm is to facilitate corporate excellence, which we define as the relentless pursuit of material progress towards a more inclusive and regenerative economy. And by the way, I'm going to do a shout out for UBS. When I started with UBS, and before that, actually, most people don't know this, but about 20 years ago, a tagline from UBS was the relentless pursuit of our clients' success. Our clients' success. All right? I like that for Cornerstone too. So if finance is a tool, all right, the new financial literacy is about understanding the power of money for what it is, all right? It is a mechanism for transactions. It is a store of value. Money is not good or bad. It is, all right? It's a tool. So if you want to look more about that, thenewfinancialliteracy.com, which is a partnership with High Water Women, which you all should know about High Water Women because they rock too. And on that note, I thank you. It is a privilege for me to be able to work with people like these on a panel. So thank you very much, and thank you guys.